Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. It's our Thursday edition of Trader Talk in today's market, and I'm your host, Kevin Horner. It is a beautiful morning in Denver, Colorado, often the case, obviously, but pleased to be with you all today. Going to look at a bunch of charts. We've got a bunch of stocks in the news. We had a little bit of selling yesterday as well. Obviously, the market been on a wonderful trajectory. We're going to talk about some of the levels that are important for the broader indices, of course. And then we're going to look at our individual sectors and move into some stocks in the news. And today we are following up on last week's trade. We did an example trade in a position just to kind of add a new wrinkle to our solo Thursday shows. So looking forward to following up on all of that with all of you. So thanks for being here. I'm joined by my friend and fellow Schwab coach there in the chat, Barb Armstrong. Say hey to Barb, who will get to comments and questions that I'm unable to. But Barb, of course, a wonderful coach. She'll be joining me in San Diego this weekend. We're both looking to take to the skies here this morning. And for those of you coming out to the event there in San Diego, please be sure to stop by and say hello. And follow the both of us on X, Barb Armstrong CS and Kevin Horner CS, a great spot to find us when we're not hosting classes for you here. You can also find both of us on LinkedIn as well, and we would appreciate a follow wherever it is that you are in the social. So with that, let's get to our disclosures and we'll move to the charts. So first of all, remember that everything we discuss today should be considered informational and educational only. We do not make recommendations nor any endorsement for a specific approach to trading the market here. What we will incorporate, though, is technical analysis as we review the areas of the market for you, giving consideration to the technical analysis concepts and strategies traders might choose to employ. It's important, though, to remember that technical analysis should not be considered a sole means of research. All that means is we want you to utilize a multitude of factors when you're deciding whether to take a trade one way or the other. So do not rely exclusively off technical analysis for your decision-making process. Now, we do follow a top-down review of the market. This is our agenda. Starts broadly, major indices, so the S&P 500, the Russell 2000, the NASDAQ 100. We work our way into some important industry groups, sectors on the domestic side of things, and then stocks in the news. So, like I said, plenty to get to today. Now, let's start us off with the S&P 500, where we're opening lower, but already getting a bit of a bounce there off of that initial low. Now, that initial low here can be tied to the prior highs. And you'll notice that when we broke the last high we made, we did it back here. And we needed 3 days really to settle in and kind of validate that level, which appears to be right around, well, how about that, a round figure, 7,500. Always nice to see those round figures holding up for us. Let's see if we can take a look at it on a little longer term chart here. Here's my hourly going back basically to that first week of April, and there's that line that I drew in. So you can see that we have a spot potentially for management of risk. If we're watching this upsloping 200 period, in this case 200-hour moving average, that could be providing us some support, but you'll notice from where we are right now, we're about 120 points away from that level for trend management. So some of you might find that one a little slow. If we just work our way down the moving averages, the 100-hour moving average happens to be pretty consistent over the last few months here. If we go back to April when we took this one out, that has been pretty darn stout in the SPX. So maybe for short-termers, this 100-hour moving average could provide some area of support. Now, let's not get too enthusiastic with our move this morning because we do have a gap created and we know the importance of gaps. So any rally that loses steam at the level from which we have fallen puts us in peril, right? Doesn't mean that we are, anticipating reversals or anything like that. It just means if we can't get through that 75-55 zone, well, then we have the risk of returning to the low we opened at or potentially testing the 100 hours. Again, what we're talking about here, it's never about anything certain. We know that much, right? The trends of the market are never certain for us. We have some leans one way or the other. We talk about probabilities. And so when we break through a certain level of support, the probabilities for moves to the downside are greater. We want to see a move through the white line here so that we can increase the probabilities of the trend in the S&P continuing to the upside. A rejection from here increases probabilities of more choppiness and potential for a deeper pullback than what bulls want to see here, of course. So again, just remind yourself, it's all about probabilities, and how we manage those probabilities comes down to how we prefer to be invested in the market. A lot of the time, many of you traders will be a little bit in, a little bit out. As you gain confidence and comfort, the probabilities lean in your favor. You add to positions. When probabilities shift and become less favorable, then you take away from those positions. That's the management of a trade. That's the process that we traders need to follow consistently. So keep that in mind. All right, let us move back to the daily and let's take a peek at our NASDAQ 100. So pressure is on tech today, down 1%. We're going to look at Broadcom in a little bit when we get to stocks in the news, but Broadcom certainly pressuring after having made a wonderful move to the upside and following its earnings announcement was not as well received, and we'll talk a bit about that. So the NASDAQ pulling back a little, down 1% with a big gap move. The 20-day resides beneath us pretty effectively as potential support. Horizontal support consistent with that level as well, right around 29.7 on the NDX. So that's still, as you can see, about 500 points away from where we are right now. The 10-day moving average here has been consistent as well. We were below it for one close, but we were right back above it. So some traders will make note of the fact that that's our intraday low. Maybe that holds up for us. It's possible. There's nothing to guarantee one way or the other, of course, but watching the intraday low could be instructive for the remainder of today for many traders. So doing so on that hourly chart could be a way of monitoring it, right? And so setting a line in here, knowing that your odds for a deeper pullback increase under this 30,160 area, and we've got that layer down beneath us, like I said, at 29.7. So again, remember, nothing is a guarantee to happen, right? We're just talking about movement through this level increases the likelihood of one move or another. And the more you get comfortable with that idea, I think the better we can be as traders. So that's what I want to reiterate when we're watching all of these individual groups. All right, back to our standard moving averages. Let's take a peek at our small caps. Russell is a little bit favorable, pretty flat, but ultimately holding on here just fine. Getting a bounce. Looks like we did fill the gap here, the one from just about 2 weeks ago. So we had some resistance that became support, essentially. So we've not actually tested this level, but the 20 has been pretty good. And I think a lot of short-term traders are going to be relatively pleased with the action of the last week and a half here, because we have broken out, but we've really not given back a substantial amount of the rally here in the Russell. And we did make new highs in the Russell just a week ago. So this admittedly is showing a divergence in price. We have the RSI down below making a lower high when we made this higher high in price. So here's your uptrend from the last peak, and yet RSI downtrending. So we have a divergence. How we choose to manage that is up to us individually. Just remember, divergences, we cannot, as traders, infer that a divergence leads to a reversal. It could just mean that what we're getting is what we've had in the way of price, believe it or not, a consolidation over support. And that's exactly what's been going on. So the fact that we've not broken the 20-day will stand out from a trend management standpoint to a lot of short-term bulls and gives them the confidence to maybe stick with things. Also gives them the confidence to say, hey, under the 20-day, I'm going to have to be a bit more defensive if I'm not willing to ride it down to the next ledge of potential horizontal support, or possibly even just the 50-day moving average, which is right above us here. So 2750 is where the 50-day moving average is, but horizontal support down in the neighborhood of 2720 could also provide that support if we were not capable of maintaining our shorter term trend at the 20-day. And as usual, for those of you who are not necessarily here as frequently, one of my main reminders as it relates to these decisions that you're going to be making on your positions is to do the math. Right? Just know what level of downside risk you are considering. So if we thought, for example, that a break of the 20-day, a close below the 20-day would bring us down to the 2720 zone, could we stay with our entire position? Well, you have to know, what does that mean to me? That means a 5.25% position move to the downside. So if I had, $100,000 invested in that, I would be looking at a $5,200 move to the downside. If that dollar amount is too great for you, then you got to look to reduce position size. If that dollar amount is comfortable and that movement won't hurt you, and you would only under this zone, for example, then make a decision to be more defensive, well, then you can stay with your current position size. Just do the math. Put yourself in a position of comfort every step of the way. That is the reminder I want to offer you as it relates here to what we're seeing in the Russell. Now, I'm going to clear this out just for our ease going forward. Now, let's go ahead and look at the one thing that is likely to give us a little bit of lift if we can get the Russell to rally. Chances are yields are going to fall. Now, the takeaway on the yield, the 10-year yield at least, we have been monitoring the 45 level on this TNX:CGI, and you can see why. When we were above it, the Russell was under pressure. We were above it for a quick window. It was about a week and a half. Then we got thrown back below 4.5. Now, interestingly enough, we have not pushed through it yet. So this line has to be now considered resistance, seemingly a really positive development to stay under this level for the Russell 2000. Now, if we can continue to push this down, then we will continue to see improvement as it relates to the small caps, most likely. Remember, the main reason that we're getting so much of a relationship here is because the vast majority of small cap companies are utilizing debt to do their business. That means that as debt reprices, higher yields, higher costs to the firm. That is a challenge to their bottom line. So we want to find these opportunities where that's not really the case. We want to see lower yields so that these companies, when they get into the scenario where they need to reprice debt, they're doing so at more affordable rates rather than higher rates. Now, it may be a while before we get to see these rates at a level that would be really beneficial, but the takeaway that we've had as it relates to the movement in the Russell versus the movement in the yields is that as long as we stay under 4.5, chances are we've got a positive outlook on the small caps. So let's keep an eye on this. All right, let's look at our skunk today. That would be the semiconductors. Now, let's not get too overdone. It is diverging with a high, but we also had all of these highs achieving above the 70 line. And frequently a trader will tell you, hey, divergences are notable. Divergences can lead to pullbacks. Divergences can lead to consolidations. When a divergence happens as in this case, the index, the semiconductor index, when it happens like this, where all of the peaks are into overbought conditions, though, it's less concerning. It's a very decent illustration of the true strength of this space. We know we've got some horizontal support here. We've also got it even tighter in this vicinity, right? Prior highs and potentially new support. So let's watch the breakout spot here at around 13,000 or so. A pullback to the 20-day would not be terrible. We have done so recently and held, so we'll keep, the outlook will be, hey, if we do what we've been doing, well, then any pullback to the 20 would be an area where bulls might very well look to expose new dollars to their opportunities here. So very important, not so much important on the short run here at the ledge we're sitting on, but the 20-day will be pretty instructive for us. And then the next layer, of course, I can just snap and duplicate that line. Let's just put it down here. Happens to be pretty consistent with the 50-period moving average, the 50-day moving average in this case, at this moment. Of course, by the time we get down to this area, the 50-day is apt to be a bunch higher than where it is right now, assuming we don't sell off that distance very quickly. But as always, know those levels, right? If we found the 20-day from where we are right now, let's see, that'd be about 7% to find the 20-day, so that wouldn't feel great. If we found the 50-day in short order, we'd be looking at a pretty healthy pullback, wouldn't we? Yeah, about a 20% drawdown to the 50-day there. So from where we are, it would be a possible scenario by which traders would look to throw some more money into the semis. I mean, my goodness, if we got the semis down 20% from where we are, not to mention 20% from our highs, that'd be notable. In fact, we would be 25% from our highs at the 50-day moving average today. So that does seem a little bit notable here. So yeah, we're getting a little bit of weakness. We were due perhaps for a little bit of weakness, but let's not overthink things. Remember, working with trend. That's why we talk about the various moving averages that seem to be providing some areas of support for us. Know the ones where you want to take action. Okay, so we're going to move next to transports, but before we do, we are going to take a look at oil. I'm going to use the futures symbol for oil, and a reminder that we're not encouraging futures trading nor advocating for it. If you want to trade futures, it's absolutely available to you here at Schwab, but make sure you go through the requisite steps. Here, what we're utilizing the futures symbol for is an understanding of trend. We've been talking about the break of that uptrend line that was working so effectively for us, and then suddenly it wasn't. Now, what I love about this chart is the consistency that we've seen since the breakdown and the ability to lean in to some key details and reminders as it relates to the concepts of technical analysis. And first and foremost, what once was resistance, once broken, can become, what once was support, once broken, can become resistance. So whether you were working with the white uptrend line, which it could now be considered resistance, or if you were working with the 50-day moving average, which could now be considered resistance, you've had some clarity provided over the last week here, right? Now, let's look at this on an hourly basis. So oil rallied in to basically support, right? Former support, potential resistance. I'll draw that line right here. And that comes in around 96 or so, 96 and a half. Then we've gotten thrown back. Now, are we setting up a higher low? So you can see I've got the 100-hour moving average still in here, and it has worked, hasn't it, everybody? If you used it here, you could see we were resistance there, we were brief resistance here, and then we got the pop higher. And so resistance, 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 aha, support. So we can see that we made a support test right here, and support test right here. Are we seeing a potential bounce, a potential higher low, and a potential to rally right back to 96.5, which would obviously continue to pressure the entire broad market? Now, the move lower today is likely one of the reasons you're getting a lift in transports specifically. So let's migrate into the transport index. Let's take a look. Interestingly, breaking a little bit of a bull flag in here, huh? So this actually has a bullish bent, a bullish lean at this point. And so at this spot, many traders are going to be thinking about the potential for more upside. Now the question becomes, is that a direct correlation to oil, and will this possibly reverse if oil starts to rally that way? That's a question that we all should be asking ourselves. I don't have the answer for it, of course, but that's what we're looking at here. So transport's moving a little bit higher. The lack of volume as we've consolidated might give bulls confidence to say, hey, that means that there's been no selling as we moved sideways here. So as we did move sideways like this, volume was not substantial. So not only were traders not really stepping in, but they weren't unloading transport positions either. And so the fact that we've broken to new highs short term could lead to some additional buying. Now, there is a very limited amount of resistance above us right here that we probably need to get through, but you know, that's a fairly minor resistance on this chart in particular. So we'll monitor that. Now let's look at the legs of the stool, as I like to say. So we'll check out our airlines, airline stocks. Not as an aggressive of a move up here, but we are into the gap zone with yesterday's selling. You'll notice, you know, the oil obviously leaving airlines in a precarious spot. The transports themselves broadly held up far better, but airlines pulling back pretty good here. So what do we see? To the lows, about an 8% drawdown. That fits with standard. Gap zone, very important. 20-day moving average, equally important. We can kick this out to where we are today. There we go. So this could also provide some support. You notice we were through here and went to the upside pretty quickly. So maybe this zone is the area that is most important for the airline stocks, at least as it relates to this index. Now, let's see how our rails are looking. All right, so clearly we're still moving stuff cross country, right? The big thing to me was getting outside of this channel and then confirming the upper level of that channel. What once was resistance can become support. That's exactly what may be going on right here, everybody. A new level for monitoring, basically. All of this action here, basically above and validating the green line and the 50-day moving average as support, really gives some structure to this pattern. So monitoring rail stocks, you know, this looks like a positive development, but broadly speaking, and you know, there's not a whole lot of positions to work with, as you know, in this space, but I think this is very instructive nonetheless. All right, and then last of this group, of course, becomes our truckers. Let's take a look at the trucks. All right. Well, I got to be honest, everybody. I mean, again, I am a little bit confounded here because oil is not cheap, and yet trucks are moving to the upside. So we've got some clarity from the trucking space now. Now, obviously, the big move to the upside here could be getting a little bit tired, but I got to be honest, this is just not what I expected to see from this space. So off of the 50-day moving average, up 21% in the last 3 weeks. That's fantastic. What a great move to the upside here. So, you know, consider looking, some traders will consider looking in this space. You need to be, you know, thinking about your Old Dominions, your JB Hunts, your Saya, etc. None of which are recommendations, of course, but just, you know, the securities, the individual stocks you'll find within that space. Very interesting move here, higher, after having taken out resistance. You know, and again, if you're not a comfortable buyer on breakouts, well, then we need to be paying more attention, right? The technical analyst believes that new highs are bullish in nature, not bearish in nature. And as you can see here, when this got cleared, it didn't immediately move up, but it's been pretty darn consistent for the last 2 weeks. It has moved up quite nicely, about 2,000 points up here over the last 2 weeks. Just a fantastic pop. So fall back on your basics, fall back on your process, and remind yourself that the technicals can give you ways to manage your trades. And you know, Barbara, I'm going to tell you, logic or not, that's what's happening. Prices are moving to the upside. And remember, the thing that we often get bogged down in is the headlines at current moment. We're watching headlines, paying attention to headlines, and it's impacting our willingness to take the trades that are showing on the charts, right? Remember, what's happening in the market, what's happening in these charts, these are likely 6 to 9, maybe even 12 months forward looking. The market discounts everything. The market is taking into account, that is to say, the traders who trade these positions are taking into account everything that we have seen, right? They know all of the same risk factors that have you concerned, okay? That is known. That is on the table already. The prices are moving to the upside in this particular space. You can choose not to pay attention. You can choose not to play the opportunities that are provided, but understanding it is less important, perhaps, than simply leaning on the technical aspect of it, because commonly we overthink it, right? We traders, we will overthink things all the time. In fact, I'm very guilty of this. It's why we give the idea of setting some rules for ourselves, planning our trades, and then adhering to those plans. So I'm just trying to reiterate that there are ways for us to get better as traders if we lean into the things that we have comfort with. Buying breakouts is one of those things you just got to get comfortable with in bull markets. And boy, this one has worked out quite well in the trucking space. So pleased to see that, as am I pleased to see yields continuing lower. The VIX is flipped to negative from positive, so volatility is decreasing here. Probably means that over the last moments or two, we may have seen oil pull back further. Let's take a look. Yeah, so oil now has a red candle on this hour, and if we can take out this area, if we can make a new short-term low in oil, maybe we can anticipate some additional green on the screen this morning. All right. Let us look at some of these sectors on the move. Now, yesterday, Brent Moores and I talked about the movement we've seen on a 20-day basis, with tech really being in the lead. Now, tech has not took a pretty good move on the chin yesterday, right? So we're not up as high as we were. We're getting some movement into healthcare as a leader today. We'll talk a little bit about why. We've got industrials holding well, year to date up 12%. That also goes towards those transports as well. So bear that in mind. And then staples is an area that I've been talking about. So let's hit a few of these charts. Let's hit staples to get us started, because I'll tell you, I just thought that this was an interesting chart. I talked about this a little bit on the network yesterday. Remember, the network is a separate but affiliated company owned by the Charles Schwab Media Group, the Charles Schwab Network, that is. And the pullback that we saw to the 200-day moving average here seemed to be pretty interesting to me. And so I thought that this was an area that could be witnessing a bit of a bounce. Sure enough, we got a hold yesterday and a follow-through day today. So, if nothing else, exposing dollars as we find 200-day moving averages in broad spaces is a way that some longer range investors go about their process. So bear that in mind, I suppose. Now, healthcare, we've seen some upgrades in the healthcare space, and I talked about the importance of this group as well. This is a wonderful development for healthcare collectively. We have been in that consolidation after having broken our trend, right? Well, now that we are outside of that consolidation, you are now trading in healthcare at essentially the highest we have seen in 2.5 months. So this is, yes, Kelly, possibly defensive in nature, getting to be a little defensive in nature, but I'll remind you that's not a negative as it relates to the broader markets. Remember, we have been seeing, I'm going to use the equal weight, the S&P 500 equal weight index, we've been seeing this move to new highs. This, again, new highs in the SPX equal weight. That is, again, not a bearish development. It might bring some of the growth into more reasonable levels, but by no means does it tell us that the market is due for selling, right? I'm encouraged, and I think a lot of traders are encouraged by what you're seeing here in the equal weight. And if we were just to try and give us an idea of where could we end up in equal weight, well, we've got a beautiful cup and handle here, don't we? Pretty clear. So here's the first side of the cup. Here's the second. Here was our handle. And so basically just measuring the depth of the cup will tell us a potential measured move target if we were trying to get a feel for things. So I'll activate that line and just put it up here. And then that becomes your approximation for a measured move target. So that might push the equal weight up to the ballpark of 9,000, which is 500 points away. That's tremendous. So a wonderful opportunity. By no means are we a lock to get there, no guarantee, but we would say that having broken this range and held it for the 2+ weeks we have a greater opportunity now to achieve 9,000 or our measured move target than we would if we were below. And I know that sounds pretty obvious, right? But we need to lean into those reminders. Okay, that's how we take advantage of our opportunities. So, encouraging news on the equal weight, encouraging on staples, encouraging in healthcare. What about financials? I've been talking about that one. I posted this one on X yesterday. Intra-period, I felt great about this one. I didn't know if it was going to bounce, but I was talking about this gap, and it held. Sure enough, bounced right off of it. And now we have potentially broken our downtrend line. Some of you would say, Kev, redraw that. And okay, we're right at it. You know, we either at it or have broken it. It's a art, not a science, as you all know. But that's an interesting move here in the financials as well. So worth eyeballing here. What else do we have? Okay, so we've got staples, healthcare, financials, and let's quickly hit that industrial chart. So industrial still holding up that 50-day moving average cleanly. So getting some improvement there. And then let's see, the other one was discretionary. All right, so if you're looking for a reason for discretionary, or a reason for considering discretionary, how about horizontal support and the 50-day moving average in here? So an improvement today, right, bouncing off of the lows yesterday. Now, this is an improving look at things. Could it get back to where it was? Sure, it could. Obviously, a move through that upper level would be the key development, but risk versus reward favors the bulls here if the trader's willing to move on under the 50-day moving average here. So that was positive, potentially as well. Okay, now let's get to some of the reasons why we're getting market movement we are today. So I'm going to bring up some of these stocks in the news. As I mentioned, we know that Broadcom had a rough go of things. So let's pull up AVGO. Now, it should be pointed out that Broadcom was doing exceptionally well. And the move it made from March 30, down here to the peak was 71%. Now, from a trade management standpoint, I know it's really hard to look at 71% and say, I should be sticking with this. Chances are some traders took some risk off the table with the move to the upside in advance of the earnings announcement. And then, of course, the announcement today leads to a pretty healthy move lower. But it did not, to this point, do a whole lot to destroy the true trend of this move because what we've done is pull back to former resistance, potential support, 50-day moving average, a common spot for a trader to join a trend if it holds. So the important thing will be what happens over the next couple of days at this level. Does the 50 days hold up, essentially? I see your request there. Yeah, let me open that a little for you, gangs, just so you guys can make note of it. But if you're looking for these symbols, just remember, it's always the SP500 hashtag 10, 15, 20, 25, 30, 35, 40, all the way down to 60 gets you the full look at everything. So that's the symbology we're working with there, everyone. So let me give you the detail on Broadcom. So we had some adjustments there. We actually had a downgrade on Broadcom at Macquarie, downgraded Broadcom to neutral from outperform. New target on this at 437. That's down from 513 following the fiscal Q2 report. The firm cites Alphabet's shift toward insourcing their chips for the biggest reason of the downgrade. So again, from a trade management standpoint, nothing we could have done to position ourselves aside of taking profits ahead of the selling, right? Because if you would have put in as an example, this is what we talk about so frequently when we talk about stop orders, everybody. You could have put a stop in here at 470 and that would have been feeling good. Oh, if I get stopped out, it'll be close to 470. But today's open would have been a trigger. To trigger that, it would have happened at 408.99. Any stop order that was set above 408.99 would have triggered and executed really close to 408.99 regardless of where the trigger was set. So even if you set it at 470, your execution would have been close to 409 today as opposed to 470. That's the risk of a stop order. I want to reiterate that when given the chance. So, okay, now we also today have some upgrades, but the upgrades we have are located in the healthcare space. So let's look at a couple of those. How about United Health? So we've been watching United Health for a while. Reminder of the big moves we've seen. Let's go to a 2-year chart on United Health. All right. So the big thing here is that we have really seemingly fixed our downtrend. Why do I say that? Well, we have moved through a big zone that we had gapped on. Now, not only did we move through it, so first of all, it was resistance right here, as you can see, right? We moved to this level and pulled back. So the first test, not really a surprise to see us move up there and then get rejected. But what's nice right now, let's go with a 20-day moving average. Check this out. Oh, looks like we got stopped on something or sold some shares. We'll address that one next week. That's for my building a stock portfolio class. But the move here is really intriguing, right? Let's zoom in back to a 1-year basis. So there's our mid-range high. Here we broke to new highs, short-term highs that is, pulled back. What did we do? I've already said this one a number of times today, everybody. What once was resistance can become support. And that's exactly what happened here, didn't it? Broke out, pulled back, held. Yes, we got an upgrade today, but that upgrade has led to a break of our downtrend line, and now bulls are back in gear potentially. Now, a move through the high we made last 2 weeks back at around 403 would be a positive development for United Health. Now, the note here from Bank of America on the upgrade is that moving from neutral to buy, new target at 450, up from 420. The incoming data points, quote, make it more difficult to believe that the strong Q1 was purely a function of weak flu and storms, end quote, according to the analyst. He says that he argues that United Health should lead a broader managed care rally if the utilization trends continue to moderate. So improving medical cost trends and supportive near-term data points set up a favorable Q2 earnings opportunity, according to the analysts at Bank of America. So that seems like an improving chart, what we're seeing on the short-term basis. And if we looked at it on a longer term as well, it's also significant, isn't it? Boy, does that stand out, everybody? I mean, remember, always a good idea to take a look in the longer term. This one, if we squeezed ourselves into an area of resistance above us, could it be the 200-week moving average? It could. That's around 460. But there was also a fantastic ledge of support that we fell through. And I'll bet that a lot of traders are going to first eyeball this as a potential area of resistance. And that's at about 440. But hey, that's 10% from where we are right now. So just a interesting look. But on the chart, what does it resemble? Sure looks like a quick bull flag on the weekly after a fantastic move up, doesn't it? So we'll see if that continues to play out bullishly, having a nice green day here, up about 6%. Another one in that space, Oscar Health, OSCR, got an upgrade as well. Oscar was upgraded at Wells Fargo to equal weight from underweight with a target at 20, up from 11. The firm cites greater confidence in their 2026 exchange market trajectory as the reason for the upgrade, stating that they are now increasingly comfortable with the trajectory of the stock. Oscar's visibility beyond this year remains low, according to the analyst, however, so be aware of that. But a nice move off of this low created yesterday, back above the 20-day. The level in the short run that seems to matter is the one we just tested this week, or last Friday perhaps, right about here, around 2340. And if we went ahead in to the, so it's still, that's the same spot as you can see on my hourly bars. So movement through this, so you can see we've just paused as we got into this area. So a movement through about 23.5 could be a really positive development over the coming days in Oscar Health. All right, so I wanted to make sure we got those for you. And then let us take a look in our final few minutes at that position I was mentioning we took last week. That's Synopsys. So let's take a look at Synopsys, SNPS. So we've got a stop order. I'm going to put up all my trade details, and let's put the specifics in here so we can see my trade. All right, so we went long here, 489.34, believing really that what we've got was a longer range opportunity based on the 50-day and the 200-day. So we've got an improving 50-day. I'm going to hide the 20 for the time being, just so it doesn't dirty up our chart. And what we see is the holding of the confluence of these moving averages. So this area provides some support here because we've got the 50-day, we've got the 200-day at the same level, kind of reiterates that price range. And we utilized an average true range calculation, an ATR, to place our stop below that confluence. So currently our ATR is, we can call it just as a ballpark, $21 a share, okay? And that level is about 466. So we would want to make sure that we are, somewhere in the vicinity of about 445 or so for our stop. Currently, we are in at 442.87, a little below that. With fact is, we have not moved to new highs, so there's no reason to make any adjustment to our exit strategy on this at this point. But going forward, what we're hoping to see is a rally through 535 to the upside, which would give us an opportunity to greatly lift our stop order. We might thereafter use 535 as the support and the basis for our calculation. So we may then say 535 as our breakout could now be considered support, and then we would look beneath it by the amount of our ATR, which would put us down to around, 514 or so, as the approximation of where we would then place a stop. And, again, I'm just giving you some ideas as to what could play out. We don't know, but bulls are probably a little bit encouraged by the fact that we've got that golden cross potentially happening right now. And then they'll also call out the fact that the lows over the last 2 months have all been held. Here we've had this outside of the one big swing day here on earnings, everything has been held pretty well. So the low here at about 470, 472, that looks to be an interesting area for potential support. But when you're talking about trend management, everyone, sometimes it's just as simple as saying, well, if we're at 472 and then the moving averages down below are just 5 or 6 points away, many traders are just going to go with the lower level for their calculation, right? Just giving themselves a little bit more wiggle or a little more opportunity. Okay, and I just realized that, yesterday we had a request to hit Bitcoin. I didn't look at Bitcoin, so I thought we could do that as well. So quickly, we'll look at Bitcoin, and then we'll wrap the session. So Bitcoin's been under pressure, and I posted on X about this one as well. You could see we got down to 63. That was my question on my post. Is it targeting 63? And sure enough, we got there. So today, the low, 61,545. Notable. But as is the bounce at this level, right? That's just as notable as anything else. A hold of this level could give bulls reason to think we've got a shot at going right back to 81, right? We could be considered to be range bound here in Bitcoin. Now, why is the selling happening? Well, there's lots of speculation about traders in Bitcoin being very enthused for next week. There's going to be some big news on the horizon. So be aware. If nothing else, this feels like an area of support testing. If it doesn't maintain, lots of risk below, right? But interesting nonetheless. Wanted to make sure we touched on it and talked about it for you today. I know we didn't get to it yesterday. So with that, let's go ahead and wrap things up, everybody. Thanks for being here. Follow Barb and me both on X and in LinkedIn as well. And again, remember, we've got those live events for you. Schwab.com/coaching is the place to check out our in-person event calendar where we're going to be. San Diego this weekend. We've got more coming in Chicago. We're going to be in New York State as well coming up in the fall. Lots of stuff happening with our in-person events, and we'd love to see you all out there, everybody. So with that, always appreciate you joining. Thanks for being here. Have a great rest of your Thursday. And since I'm out tomorrow, you can expect to see James Boyd hosting solo for Trader Talk ETF Day. I hope you all have a fantastic weekend. I look forward to catching up with you again real soon.